Well, how about those markets last week? Not good. Worst 7 days in recent memory in a while. So the Dow was down 140 Friday, but the bloodbath was much worse in the days before. So we opened the week. The Dow index was about 32,327, and at one point we were down almost 2,000 points for the week. And obviously, the major driver in the market dropping, which we need to discuss because this is big. The Fed may be increasing interest rates up to 1% instead of 0.75% because there's no sign of inflation slowing. And not just the Dow, but the NASDAQ got beat up pretty hard too. So just when we thought we were recovering back in July, now we're right back in the bear market again. And it seems like we've got a lot further to go. The bear market has not hit its bottom yet. So the Dow, or I'm sorry, the NASDAQ lost almost 1,000 points last week. And it's already down the most of any of the major indexes this year. I believe it was down about 20% for the year, but let's check here. Actually, almost 28% since January 3rd. And then percentage wise, the Dow is down for the year almost 16%. S&P 500 got hit pretty hard. Now, if the S&P crosses below 3,600, that could signal like a new support point, and it could signal a lot more blood to come. But for the year in the S&P, we're down almost 20%. Russell 2000, which for the most part I kind of ignore, because Russell 2000 always underperforms, but it's down about 21%. So I actually reallocated to small caps this year, thinking they wouldn't get beat up as much, but they're getting beat up about as much as the S&P. And what we need to talk about, the big Fed meeting is coming Tuesday, and that's when the interest rates are going to be announced. And the thing with the economy, the way it is now, I mean, obviously we're in a recession, and I just did a video on that about a week ago, performing very well. Perfectly edited video, very happy with it, over 1,000 views. Check it out if you haven't. But I would say at this point, forget recession. I mean, we may be talking depression at this point because right now, energy prices have driven inflation largely. But what we saw in the CPI number is that the non-energy inflation continued to go up. So factoring out energy, that part of inflation is still going up. But my theory, I honestly think the only reason why gas prices are falling, for one thing, is that we're tapping into the strategic reserve, which was built up over the last few years, without getting too political here. And obviously, there's a midterm election coming up, so it's advantageous for those in power. The lower gas prices are. Many pollsters actually will say the price of gas is directly tied to the approval rating of those in power. So, gas prices are dropping now, which is a good thing. I mean, I'm happy about that. Don't get me wrong, but I'm afraid that after the midterms are over, they're going to shoot right back up to $5 and $6 a gallon. So, energy is going to keep driving inflation. But worse than that, the continued increase in the interest rates, it just feels like it's almost like an engineered crash of the economy in a sense. Not to be cynical, but I know for one thing, and I've gotten a couple of comments on this, which I agree with. Not to be too cynical, but if you look at the main client of the Federal Reserve is really the management class in this country, and not just that, but I mean, the big corporations, the rich, the people that have the most investments, Wall Street. And what do we have right now coming out of COVID? We have the great resignation. We have people that got to work from home for a year and a half or 2 years that don't want to go back into an office. Well, guess what? They want you back in the office, and they'll go to great extents, including crashing the economy if they have to get you back in the office. So I guess it's our job as entrepreneurs and financial savvy people. It's more important than ever to find side income and sources of side income, because most of us that have worked in an office, I think most everybody can't stand the grind of the 9 to 5 going into an office. That's why a lot of people come on here and start YouTube channels and start blogs, write books, start websites, start side businesses and things like that. But obviously, a recession, in my opinion, will make those things harder because the worse the economy does, the worse that those potentials for side income are. Because if you think about it, when a recession happens, people have less disposable income, and that's less money they're going to be willing to spend on those side hustles. Like if somebody's going to Uber or DoorDash to deliver food or anything like that. As disposable income declines, those are the first things that are going to be cut back, right? So I think it's more important than ever to find sources of income outside of your main job. Of course, like I did in another video, and like I said, try to increase your income if you can. But with all that being said, the screen that I have up here right in front of you, this is the forexfactory.com site, which I actually haven't talked about in a while. But I'm on Tuesday, the 21st, because you can see here in red at 2 p.m., we're going to get the big Fed statement, the FOMC economic projections, the statement by Papa Powell, the Fed funds rate. We'll get all that at 2 o'clock p.m. So it could be a bloodbath for the market. We could have a lot more room to drop. And let's go back here and look at the futures, because I think all the futures were way down the last time I checked. So we're going to look at that, and then maybe it's not showing futures yet. Not on here. And then I have another article to go over. But let's see here. Let me Google the futures here. For some reason, Yahoo's not. I still got to master this after hours trading. But yeah, a lot of red in the market. I mean, obviously, I wear red when the market's down. So, I mean, this is like a dark red. A lot of red in the market. Let's see here. Come on. Dow futures. This MacBook is really slowing down. Come on. We'll go to CNBC here. Yeah, because like I said, I don't think the true bottom is priced in, especially if we increase by 1%, which is very likely. Okay, so right now Dow and S&P are unchanged, so they must have come back. Implied open, slightly up. Love that, how they call it the implied open. It's implied that it would be slightly up. Anyway, let's go to another CNBC page here. This article. We had the worst day for the Dow since 2020 last week. So yeah, it tumbled 1,200 points midweek last week. Worst day since June 2020 after red hot inflation report. Key August inflation report came in hotter than expected. And like I said, the big takeaway from that is that the non-energy portion of the CPI or consumer price data increased. So it looks like, I mean, there's really no end in sight to inflation. The government's still spending massive amounts of money. The so-called Inflation Reduction Act actually added like another $1 trillion to the deficit. Plus, we're forgiving student loans and stuff like that. So we just keep pumping more money in. So it doesn't seem like the problem's going to get any better. And there's a lot of things that we've kind of shot ourselves in the foot economically. And this is opinion based. I mean, we could be drilling more for oil domestically. The electric cars and the green grid aren't quite where they need to be to where we can just, do like a direct cut over to that. I mean, it needs to be phased in. And, electric cars obviously are powered by coal, which some people believe is dirtier than gasoline and petroleum. But for us going from producing the oil that we were domestically to importing it again, it just seems like we're shooting ourselves in the foot. So just be prepared economically, because it doesn't look like things are getting better anytime soon. But I guess the silver lining, the worse things get, the sooner the Fed will start to cut rates again. And remember, once the Fed cuts rates, the market should flip like that, because that's kind of what always happens. The Fed kind of like overplays its hand and then they reverse course. So some people thought that by the end of the year that could happen. But I think worst case scenario, maybe within a year, we could go from increasing rates to cutting rates, because it's happening fast. I mean, they keep increasing like at historic levels, like 40-year levels. And I really think that's what it is. I mean, you read more and more articles about like how the solution to inflation is to get people back into the office. I hate to say it, but they don't want you to have that freedom. They want you like a hamster on a treadmill. They want you in that office 40 hours, minimum 40 hours a week. Of course, they love more hours than that. And I can attest to that, of course. But that's a bummer. But it seems like that's what they want. It's control. We have a capitalist society, but it's a lot about control and keeping you. And the thing I notice, me personally, like when I got to work from home, my ability to come up with good ideas, think freely, and all that was much better. And I feel like, again, not to be cynical or go off on a rant, but it seems like we just can't have that. We can't have too many people. We can't have too many people. Coming up with good ideas, being entrepreneurial, trying to do new things. But that's why I would tell all of you that it's so imperative that you do what you have to do. You come up with your own ideas. You have to take big risks. If you have to go jobless for 6 months or whatever, if you believe in your ideas, if you believe in your entrepreneurial uh, goals and stuff like that, you got to do it. And in some cases, I could probably take some of my own advice in this, but that's what we got to do. I mean, we got to come up with new ways to make side income and maybe turn some of those side hustles into the main hustle. With all that being said, that's really all I wanted to discuss today. Just, really prepare, because things economically don't seem to be getting any better. We could have a, once in a lifetime confluence of events happening here. Of course, like Jamie Dimon says, economic hurricane coming. He's even referred to like once in a lifetime clash of economic events here. So I would just say prepare yourself, make as much money as you can, save as much money, cut your debts as much as possible. Keep tuning into my channel. I'm always going to be on here giving ideas and education and coaching. So thanks for watching. And if you like that, please remember to like, comment, and subscribe. And I forgot to mention dividends. This is a great environment for dividends, obviously, because the lower things get, the worse the economy does. And I actually just moved back to my main screen, so I see a comment here. What does it say? I'll actually read this comment out. I haven't done this before. This is, I'm not that experienced doing live streams, but what is Maximino here says, my strategy is still the same, putting money into JEPI, JPQ, Devo, and XYLG. Yeah, I agree. I like all of those. I'll have a bigger cash flow after everything clears up. Exactly. That's my strategy too. I'm focused more on dividends, because a lot of those, like if you look at the oil companies like Exxon, Chevron, when they were at like zero, they were still paying out dividends somehow. So some of these dividend aristocrats, the dividends never stop. So I think in this scenario, in this environment we're in, dividends become more and more imperative. But anyway, with that being said, I'm going to end it now. Please remember to like, comment, and subscribe, and keep an eye out for my next videos, and take care.